Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Neil Timmins. Now, Neil is the founder and CEO of Legacy Impact Investors, an Iowa based investment firm focused on industrial real estate investments throughout select Midwestern markets. More specifically, his team is dedicated to identifying small to mid balance Class B industrial assets with long term growth potential. Now, Neil got his start in real estate back in his 20s, and I'll let him fill in the blanks there once we bring one here on the show. But he got to start in the 20s, and ultimately by the age of 29, had become the number one Remax agent in all of Iowa. And from there, he was introduced to the investment side of the industry, where he ultimately decided to focus on industrial assets as the target investment vehicle of choice. Now, in addition to his investment endeavors, Neil is also the host of the Passive Real Estate Investing with Mavericks podcast. And so, guys, without further ado, I'd like to welcome Neil Timmins to the show. Neil, how you doing today?
I'm terrific, Kevin. Thanks so much for that kind intro. It's good to be here.
Excited to have you here and excited to again peel back the onion and learn a little bit more about you. I gave you that brief introduction, but I know there's way more to the story, Neil. So if you would kindly tell us a little more about yourself, your background, and how you found your way into this investment world that we're in.
Yeah. Well, good. Well, it's a winding story, like so many of us, I think, who landed in have landed in real estate. Born and raised in Iowa, played football, went to University of Nebraska, Omaha. So Division II, the Mavericks over there. Every day I've drove by Warren Buffett's personal house. It's about 2 blocks from campus. And so I got a degree in business. So I'd study, of course, everything business, stock, investment related, and Warren through his teaching and certainly in that city and just being who he is, had tremendous influence through the business program there. So when I got my degree, came back to Iowa, went to work in banking for a couple of years, and then talked to my mom one day. She's a stay-at-home mom of 4 sons. She's all the kids are out of the house at this point. She's going, I haven't worked in 20 some odd years. What should I do? I was like, Mom, you like people and you like houses. You should be a realtor. She thought about it for like 5 seconds and she was like, you know what? I think that's what I'll do. So she went, got her license. A year later, we're comparing paychecks. She makes twice as much as I make, me working at the bank. And I come from a very competitive house, right? 4 sons, three brothers for me. Uh, and I thought, well, darn, if mom can do that, I can do better. And so that was my entry point. Get into real estate, became a real estate agent, hawking houses.
Your poor mother. Gosh, trying to
Isn't
beat
that the
her up,
truth?
take her business from her, right?
That's the truth. Yeah. Yeah, exactly right.
Okay, so life started out as an agent. So you made the pivotal move. Was it cold turkey? Getting out of this banking world, going to be an
Oh yeah.
agent, or
Yeah.
okay.
Yeah.
So no transitional period of time there.
No,
Trying to keep the income while you're trying to create the new income stream.
you can't, Kevin, you can't be half pregnant.
That's it. I like
You
that.
either are or are not,
Both feet
right?
in.
And I was 24 at the time and young wife, and she was a teacher. And we lived well below our means. And both of us were like, well, a teaching income, although not much, it's enough. And so went from there. And, I've always said nothing will make you work harder than knowing you might not eat tomorrow. So it was
Yeah.
time to get out and get after it. And sold 37 homes my first year, became rookie of the year. And then
Okay.
it grew considerably over the course of the next 5, 6 years. Eventually, um, I moved on to Remax, maybe my second year, fast forward a year or two after, on to Remax. And then at 29 years old, became the top Remax agent in Iowa.
It's exciting. Very,
Yeah.
very cool. And so, um, just curious that first year, did your wife and you come up with a time frame like this needs to work or not work within this time frame? If it doesn't work, you're going back to the bank. If it does work, we'll continue forward. Were there
Well,
bookends put there initially?
no, I think only pessimists create a plan B.
I like it.
It is
Yeah.
where this is going to work, period. There's no, I think I
I'm
can't
trying to
remember.
better understand your personality. Is, is,
Yeah.
is there obviously a reason for these questions? So, no,
Yeah.
that's great. Love it. Love it.
It's,
You're
yeah,
you're throwing
you
all
get the
in.
idea
So,
there. No,
yeah.
make it happen.
So,
Yeah.
no, fantastic. So, tell me about the additional pivotal moment, the next pivotal moment in your life where you decided to look on the other side of the table on the investment side. What was the introduction to investment real estate? For the most part, I think we can all agree. The traditional realtor,
Yeah,
they very rarely, if ever, put on the investment hat. It just it's a complete. They couldn't be two farther opposite ends of the spectrum, right? Although they're both real estate, but they're two very different mindsets. And so,
sure.
just curious as to when you were introduced to the investment world.
Yeah. So, 2000, I want to say about 2010 probably was the best year ever for me in being an agent. That team at that time, I had a small team, sold 200 plus homes here in Des Moines, and get 2011 ish, somewhere in that range. And back to my wife, I come home one day. I've got three kids, all under 5 years old. My wife's got them all packed up in the minivan and says she's leaving for good. So all these things that I thought I was doing for my family, I'm working 7 days a week, 350 plus or minus days a year. I mean, it's a grind to perform at that level is a grind in that business, a grind. And to do it and make money, you can do it another way. Have a team of 20 some odd people. You can perform, the stats look good, but you're not making a tremendous amount of money.
Mm-hmm.
And so, you know, for me, it was an awakening moment to go, well, if am I actually doing this for them, or am I really just doing this for myself? And so I said, give me 30 days, I'll change. And you already know my personality at this point. When I say it, I mean it. So 30 days later, I sold my Remax and I exited the industry. And at that point, I pretty much went, I say sideways, I had no purpose for about a year to go. I have no idea what I'm going to do. I had money, I had savings, so I wasn't in any sort of financial strain. It was going, I have no idea what I'm going to do.
Mm-hmm.
And then fast forward about a year, it was going, I'm going to go back into this industry. I'm going in on the investment side. I know, like, and understand the business. I got to get my head wrapped around understanding contractors. I have, you know, dabbled, I'd interacted with them on the house side a
Mm-hmm.
little for various things that need to be remodeled, small things, but never to the spot where I would go and run a remodel project to fix and flip a home. But that was my entry point back in to go,
Okay.
it's 2013-ish. Let's go buy and fix and flip a handful of homes. And so that's what I started doing.
So probably still at that period of time, 2012, 2013, still a decent amount of distressed inventory kind of
Sure.
working its way out of the marketplace. Is
Yeah.
that is that ultimately what I mean? That was you understood, at least from the sales side, that there was the stress out there still. Lots of banks trying to get some of these REOs off their books. Is that what made focus on single family, and ultimately it sounds like it was fix and flips, or were you fixing
Fix and
and
flips. Yeah, you
flipping?
got it.
Okay,
What
got it.
had me focused there was a comfort level.
Yeah, yeah,
And
sure,
that's
absolutely.
a comfort level going, I know that. And if this seems like the easiest point back in. So that's where I started going into doing just that, fixing and flipping. And then I started brokering a little. I put some very fine constraints on. All right, I'll do a handful of things, but they got to fit within my time constraints. I'm not going and showing homes at 8 p.m. It's
So
not going to happen.
how long did it take before you realized that fixing and flipping homes is also a grind, just a different type of a grind?
Oh yeah. Yeah, you're right. It didn't take long, but I stuck at it for a longer period of time. I say that because it's a grind, but for me, the biggest challenge relative to brokering houses wasn't that it was a grind. It was a grind relative to 5 to 10 p.m. at night. You're still
Yeah.
working.
Hmm.
Saturday, Sunday, you're still working. So all those a grind, I could define the hours and put it into a box a little better than I could on the brokerage side.
Sure. Sure. No, that makes sense. And so you ultimately landed on industrial. It sounds like you dabbled in a few different things per your bio. It sounds like you had your hand at maybe a couple different types of asset classes, and ultimately landed on industrial. Why?
Yeah, I'll bring you forward to flipped hundreds and hundreds of homes, bought dozens and dozens of rentals,
Okay.
get to a spot where you're like, this rental house game, I think might be arguably the greatest lie in history, that it's somehow passive. That's what I mean by that. There's single family rental properties are anything but passive. To do it and do it well and prosper, you have to have a tremendous systems and scale to it.
Hmm.
We're not talking a few, we're talking probably 100 plus to get real
Yeah.
scale associated with it. And so I stumbled into industrial about 6 years ago, bought my first property. It got presented to me by a broker. Who knows? I've looked at all sorts of investment opportunities. So I looked at this and I penciled it out, going, I don't know enough about this, but let me ask some questions. Let me get my head wrapped around this. Tremendous tenant, the largest grocer in the Midwest, their bakery is operated in this building. And I'm going, well, what's my downside? What's my upside? And let's pull the trigger. 17,000 square feet, still own it today. Love the piece. Fast forward a couple of months and I'm going, you know what? I never hear from this tenant. And I'm the property manager, right? I own the thing. I'm going, I think I'm onto something here. And so that's what got me turned on to the industry. Then, as you said, we have, I certainly in the portfolio, I own a number of asset classes that are all in Des Moines. But as soon as we started exiting the great state of Iowa, it is only industrial and only flex properties, just because we're more narrow. It's easier to manage that across the borders in my backyard where it's 30-minute drive to everything.
Mhm.
You can manage just about anything.
For those that aren't familiar,
Hmm.
give a comparison between what one might describe as a traditional industrial property to that of a flex.
Oh, okay. Great question. So let's say industrial property, 30,000 square feet. It's a big giant box, metal or concrete, cement, doesn't matter which one. You'll have, say, 90% of it will be warehouse, under 10% of it will be office. A flex, that's the what I kindly refer to as the mullet of commercial real estate. You've got office in the front, warehouse in the back, right? And so you might see 25% office, 50% office. That might be a little much. And then the balance in warehouse in the back. Oftentimes you'll see, a big box and, say 10 tenants in one giant box building, right? All divided out down a line.
What's the reason to focus solely on flex versus that of both flex and industrial, traditional industrial? Is there a reason that you made the
No, we
pivot?
do both. We do
Oh, you
both.
do? Okay.
Yeah,
Okay.
yeah, yeah.
Misunderstood you then.
Yep.
Both single and multi-tenant? You look at both, I mean, both those in your portfolio, or
Both
do you
single
prefer
and
one over the
multi-tenant.
other?
Yep. Yeah.
Okay.
You'll typically find on a flex building, typically it's a multi-tenant building. And on the industrial side, it can go either way, either from a multi-tenant or a single tenant. Prefer single tenant, but we still have multi-tenants in the property.
All
Yep.
triple net leases
Going off memory. Yeah. All
for the
triple net
most part. Yeah.
leases. Yeah.
I'm
Yeah. Yeah.
assuming for
Yeah.
the most part, which
Yep.
which which is where I was going with that is what when you talk about passive, right? Like that's where things truly do become passive when you've got a triple net lease in place for the most part, depending on the property. But for the most part, you should not be all that involved as an owner with the triple net lease. So uh,
Spot on.
talk to me about vintage. I mean, is there a certain, I just want to better understand your defined buy box. I mean, we
Yep.
know, single and or multi-tenant, flex and or traditional industrial, certain age range, demographics you guys are looking
Yep.
for. It sounds like, credit tenants are ideal, but mom and pops, depending on
You got
the
it.
industry, how long they've been in business, track record, all that stuff is also in consideration. So just would love a better understanding of what exactly it is you're looking for.
Yeah, you bet. Class B, we'll buy some C plus stuff. Class B, you'll typically end up in 1980s or newer. We have bought some older product when it's been very well maintained. 30 to 80,000 square feet is a sweet spot. Most of the time, that stuff is not getting built again. It's become very expensive today to go build a standalone building for 30 or 40,000 square feet. And so you'll typically see much larger buildings being constructed. Typically, the only people building, 30 to 40,000 square footers are owner users. They're building it for their own usage, not an investor going out to market to try to fill that. We buy two sides of our portfolio, which we buy for. One's a value add component. We're looking for a value add piece in which we can realize over the course of the next 5 years. So sometimes that's mark to market on leases. Sometimes it's excess ground. We picked a piece up this year with 6 acres of shovel ready, zoned ready. That was not priced in the deal. Sometimes it's modified gross leases, morphing that over to triple net stuff. Some is physical improvement, not a lot. We don't get into a lot of the physical improvement side of things. Some vacancies. So we'll buy some things that are been vacant. We bought a piece earlier this year, a smaller one. We bought it as kind of bought two pieces at once. So a standalone building at 15,000 square feet. That was an industrial, and in the same city at 12,000 square feet in across 4 buildings, really uniquely built. So flex property, 12,000 square feet, 4 buildings, so 3,000 square feet a piece. We bought it from a billionaire. The story is she needed a place to store all of her personal goods, all of her personal belongings, because she was building a new property, a personal residence for herself. And evidently billionaires
Gosh.
have very different problems. So you and I might go get a pod or some sort of storage unit. She bought 12,000 square feet of flex space and utilized this as her closet for 5 years. So we bought it 100% vacant. It had never been leased in 5 years. So we bought it completely vacant. And right now we bought that August 1st. And so we are 75% full at this point. We've got one property left to go.
Okay. No, that's awesome. Yeah, it's funny. I always say first world problems, but that's a different tier. Like that's
Yeah.
billionaire problems, right?
Yeah. Yeah.
Uh, too funny. How about demographics? There's lots of smaller, secondary, tertiary
Yeah.
Midwestern markets. I mean, are you guys staying in the larger populations, or is your business model indicative of that of secondary, tertiary markets as
Yeah.
well?
Primarily larger populations. We're looking for at least 100,000 population in the 5 mile. So there, that will take us out into some spots. The big thing is it growing? It's simply much like anything that we do in real estate. Supply and demand is a large factor. If we have a higher, population's growing over a period of 5 or 10 years, and the trajectory is it's headed that way. Great. Well, I can get behind that, knowing that we should at least have a very similar demand level to what we're experiencing in today's market versus a decrease.
What Talk to me about this past year and a half. Obviously, the rising interest rate environment. We're seeing some stabilization come about now, and it seems as though that should be the case for the coming years, with a decrease of
Yeah.
who knows when, but ultimately sometime over the next couple of years it should teeter down quite a bit, or a little bit at least.
Right.
Um, but just curious as to how you guys have been able to navigate the last year and a half. I mean, have you been as active as years prior, more active, less active, and just understanding the dynamics of your business and how you've been able to ebb and flow during these somewhat turbulent times?
Yeah. So, as 23 started a year ago, we're having these conversations. Rates look like they're moving up at that a year ago. And so it was going, all right, well, the market's going to be tight here in the backyard. Now, how are we going to accomplish some goals in 23? And the decision was to move outside the borders of Iowa. And that's where it took us. And so starting to look through the Midwest. That's really what it was, is reaching out. We primarily purchased through brokers. So building relationships, going to market, meeting with brokers, building meaningful relationships with folks who can deliver some value to what we're doing. And then, for us, it's delivering value back to them, knowing that we can move in a timely fashion. If we're going to put someone under contract, we're going to execute.
Mm-hmm.
And that's really what it took was doing that. Bought more
Yeah.
outside of state than we ever bought in state in 23.
Yeah. Okay.
Yeah.
And how far is your reach? I mean, how far away have you gone from your home base?
We've bought in Arkansas, which is, I'd say, arguably not the Midwest. One of my sales guys lives in Arkansas, has been there for years, and so it's he's just outside of Little Rock, so it's his backyard. So his ability to drive down the street and do some business, it becomes much easier. So we closed on a couple of deals there, and then we closed on 3 properties in Wisconsin here at the end of the year.
Mhm. Okay. Okay. Oh, fantastic. And let's talk about what to stay away from. Just for those that are
Mm,
that are that are maybe considering this particular niche. And obviously
yeah,
there's many varieties of it, but just generally speaking, maybe speak to more your business model. Things to stay away from. Particular ceiling heights,
yeah,
older vintage. Number of loading docks, nuances with loading docks, extra
yeah.
parking, all these things that you guys take in consideration when looking at a potential acquisition.
Yeah. How about let's start with the perfect one, and then knowing
There you go.
everything, every iteration outside of there is like a check mark on. It's a like maybe. Um, I mean, it's a rectangle with a loading dock per 10,000 square feet, parking for employees on the opposite side of the loading dock. That way, your cars are not in competing or driving next to 18 wheelers that are loading the trucks, right? Ceiling height, we'll go down to 16 on some small stuff, but typically it's 18 foot clear height at 20,000 square feet. And then every 10,000 square feet, it needs to add another 2 feet of clear height.
What's a consideration there? So just curious. And 16 to 18,000 square feet, like you'll consider. Or I'm sorry, 16 feet of clearance to 18, like you'll consider 16, but ideally it's 18. What's the delineation there, and what's brought into consideration to say
You're
yay or nay on that
Yeah.
your
The
lower
biggest
height?
thing, why even have it is because your demand level, what's taking place in the marketplace. And some of that I'm a little gray in that because it does depend on the market. What's the competition like? Meaning what are the other buildings like for lease in the marketplace? If you went to Chicago, for example, you probably find a lot in that because the vintage is much older.
Or old, yeah.
If you went into a newer, a submarket of Minneapolis, for example, 16 is not going to get it done. You got to be higher. And so it
Right.
does depend on what's our competition look
Is
like.
that just how much we can like stack up?
Yeah,
Assuming there might be some
correct.
distribution, that
Yeah,
how high the racks
yes,
can go. Okay,
correct.
got it.
Yep,
That's
yep.
what I was
How
trying
high?
to figure out exactly what's because I mean 16 is pretty damn high. So is 18, right? And so
Yeah,
is it an air circulation? Is it
yeah,
is it just more of
yeah.
a storage component?
Brand new construction today is probably closer to 30 to 34.
Oh, okay, for the same
Oh yeah,
size. Got
yeah,
it.
yeah, yeah,
Okay, that
yeah. And
makes sense.
so, um, it also depends on the kind of business. It depends what market you're in. For example, if you're in distribution, that the clear height is a much bigger deal versus if you're in manufacturing.
Hmm.
That's the type of user who's going to occupy that space. So
Got
that's
it.
what it looks like is a box, some outside storage, wonderfully ideal. And then everything past that, everything that changes, almost none of them are going to look like what I described. So anything that changes past that, it's a maybe. And then you're into kind of more granular work to go, where how's this line up? Who's my user if it's
Hmm.
occupied? How long are they there? You're into the tenant work. But if it's vacant, it's what does my competition look like? Meaning what's for lease right now? What's coming down the pipeline that's going to be for lease, and how's this going to stack up against the competition that's there? If you think about what's at the extreme other side, physical obsolescence. And so
Yeah.
occasionally what I get emailed to me, every so often is here's a manufacturer, in many cases, manufacturer, here's the rectangle, and then there's another square off the corner of the rectangle, and then a third one off of that, and it's 200,000 square feet. And they've been there since 1975, and they put two additions on it in the course of the last 40 years. And it's because that's what their business required. And that's perfect for them. But from an investor on the outside in, I'm going, I have no idea who's ever going back in that space if these people ever leave. So
Yeah.
uh, we look at this as you marry that building, but you date that tenant. Sooner or later,
Hmm.
the tenants leave.
Yep. Yep. Determining the demand for a particular product, maybe using I'm sure you have other examples, but using the billionaire
Yeah.
storage, you bought it completely vacant. Obviously, taking into consideration is the absorption of those units, bringing them into the market. Is that solely relying upon broker intel in that local marketplace? Finding out truly what's coming online from XYZ industrial broker, leasing agent. Are there other data sources that you guys rely upon to to make that determination? Obviously, you got to build out a pro forma. You gotta make some assumptions. Is it
Right.
going to take you 3 months, 6 months, 12 months, 18 months? Are you going to be able to fill them all, or maybe you're just going to have to run with vacancies because the
Yep.
market might not be able to absorb it all?
Yep.
How do you guys come to that determination?
Yeah. You know what? I think back to my housing days when we go flip a home. We take a property ready to go to market in about 3 to 5 days before it go to market. That was the time to price it up. Now, of course, we had an idea long before that. And when you put it under contract, you buy it, you had an idea what that renovation cost was going to be. Uh, and what I would do with this is simply sit down on the MLS, what has sold in the last 60 days and what's for sale. I'll also what's under contract, what's pending today. And I'm putting a heavy emphasis on what's pending and what is for sale today. Because the odds have it, if the average home goes on the market in whatever, 17 days, I know that the biggest thing is going to be what's for sale right now. Because in the next 17 days, my property or these other properties are going to sell. So in a scenario like, we take down 12,000 square feet of vacant space or 3,000 square feet units, that typically is generally speaking, well, some sort of local mom and pop business, right? Somebody with an HVAC company, a plumbing company, a granite, whatever it may be. But it's some individual running their own business, making their own decision. And so for that, it's going out there, going to the market. And for us, yes, relying on the broker intel and the CoStar and the data that comes, but it's also just doing what they're going to do. Go online and start searching for property, 2 to 5,000 square feet. What's available? What's available on, and I mean this at a granular level, Craigslist, Facebook Marketplace. Where are they going to go? Where's that individual CoStar? And they're certainly LoopNet, Crexy. So look at the places that they're going to go and start
Mm-hmm.
seeing what's out there.
Got it. No, that makes sense. And then you'd also used another example, I think, of a recent acquisition that came along with maybe 5 or 6 acres of excess land.
Yeah.
In those types of scenarios, is the opportunistic play to develop additional buildings on that 6 acres?
Yeah. So great question. We bought that property. It had a tenant in there who was on there the last handful of months of their lease. So that tenant turned out 15,000 square feet. I expect that we'll sign a 7-year lease. We've been back and forth for weeks now, and I think we're at the final iteration of the attorney piece, getting that inked this week. 2 parcels, one on each side of the building, 6.5 acres in total. Sits in an opportunity zone.
Mm-hmm.
All 3 parcels do, the building and the 2 vacant pieces. So we immediately listed them for sale. The goal was and still is, can we sell one of the parcels, and then can we construct on the other one? Can we build out? Can we do what other people are not doing, which is build 30,000 square feet, somewhere in that kind of range, plus or minus, and
Yeah.
get a really solid user in there. And so we're going through that, meeting with contractors and pricing the thing out. I don't know that it's going to make a tremendous amount of sense. Now, if you can hawk one piece of ground at a number that makes sense, put the money back into this piece,
Mm-hmm.
knowing we're in an opportunity zone, as a result of the tax benefits, we may be able to get it to pencil, but that would be the only reason why, versus just going out and buying a piece of ground and constructing 30,000, which is not that efficient to do, versus, let's say, 100,000.
How about industrial outdoor storage? That's a hot asset
Killer.
class now. Is
Mm-hmm.
that I'm assuming you take that in consideration, at least when you're looking at industrial properties that have excess land, the proximity to highways and interstates, and just demand for, whether it be semi trucks or large equipment parking. Is that part of your portfolio today?
It's a big deal. We have it as an add-on, meaning if it comes with some ground, it's an elegant negotiable to be able to put into something, so that back to the 12,000 square feet of flex, there's about a half acre of ground on the back side of the property. And so we are in discussion with one of the tenants now to go fence in a half acre and then take that and then, pay us, add it onto their lease.
Mm-hmm.
So we're in that conversation, which does tremendous things, right? When you take this thing that just came along with it, if you will, and turn that into a productive cash flowing asset, it's wonderful. Yes. And tremendous demand for outside storage. Yeah.
I'm assuming, like, just speaking to like probably your typical tenant in a flex space, 3,000 square foot flex space. I mean, again, HVAC, plumbing, lawn care, all those service type industries that have vehicles most of the time, more
We've
than one,
got,
if they're a successful business, right?
yeah,
Trailers and other just equipment that they store, and product, wiring, or I mean, all this crap that they need room for, and most of them don't have it. So
we've got a cabling company who is one of the tenants there, and they lay
okay.
high speed internet cable, and they probably have 10 trucks
Yeah.
right on the property. And the way this is laid out just perfectly, um, for them, for their ideal space. Yeah, you're right. They have stuff.
They have stuff. They have stuff they
Yeah,
need to store. All of us
yeah,
Americans have a ton of stuff that we need to put in a home somewhere, just like the billionaire.
that's the truth. Yes. Yeah.
Neil, we kind of bounce all over the place. Just curious, is there anything else that you like to share, relevant, whether it be your business, the industrial asset class, what have you, that you feel would be of value to the listeners?
Yeah. The big thing for us is, you know, what we've done, and we syndicate deals, and I've turned around and gone back to the essentially my brethren, the industry that I came from, being a realtor, knowing that if I had a couple of things, which is largely cash flow, I probably wouldn't have been in a spot where I was working as hard as I was, where I was faced with my wife and I ultimately making a decision to exit that business. And so we turn around and we created agent optional. The goal there is to create ultimately syndication access for people to place their hard-earned commission dollars into cash flowing opportunities. And so a number of our investors are just that, our realtors. They ultimately, they burn the candle at both ends. The industry as a whole is under tremendous scrutiny today. So a lot of them are going, I have no idea if my my paycheck is going to look the same 3 years, 5 years, 10 years from now as it did this year, just because we're in an ever changing landscape. They know they need to create an alternative stream of income, but they don't want to go buy a rental property and create themselves a second job. They're really good at what they do. Same reason why, doctors and lawyers don't go buy properties. They invest in deals that you or I would put forth in because they stay doing what they do exceptionally well. So that's really the biggest thing, Kevin. Agent optional. If somebody wants to find some more information, agentoptional.com.
Agent optional. Good deal. Yeah, guys, we'll put that in the show notes. And is that, just curious, is that a Reg A offering, or how do you have that structured?
Yeah, we do 506Bs.
Bs. Okay.
Yep.
Got it.
Yep. 506Bs, 506Cs. It just depends on the deal that we do. So we're not right now. I don't have anything we're raising for, but it's about of connecting with us, getting educated. And if we've got an opportunity that aligns, we'll certainly keep you informed.
Okay. Well, fantastic. Well, Neil, it's been a lot of fun having you here. I know I'm going to be on your show here in the next couple of days, so excited for that as well. But pleasure meeting you. Appreciate you taking the time to share about you and your business.
It's an honor to be here. Thanks, Kevin.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.